This week's theme on the Retirement Quick Tips podcast is your listener questions answered. Today's listener question is, can I just use target date funds in retirement? And the answer is maybe. Target date funds, these are really popular investment vehicles that are mostly available. I mean, you can buy them anywhere in an IRA, any type of account with most financial institutions, but they're most popularly used in 401k accounts. So chances are you probably have access to one of these in your 401k. And if you do, I highly recommend that you utilize it. And you could even put most of your assets in the target date fund, and you will have a well-diversified portfolio. And studies show these have been around for a couple of decades at least now, maybe closer to like 25, 30 years. But they've been around for a long time. And what they find, there's a lot of data available because, as you can imagine, there's millions and millions and millions, hundreds of millions of people in different 401k plans all over the country, all over the world, who invest in these funds. And there's also people who in the same 401k plans don't invest in these funds. And so on average, a person who's in a target date fund, retirement date fund, is actually going to do better than someone who is picking and choosing and cherry picking their funds and just picking what they want. And this makes a lot of sense because as an individual investor, when you invest in your 401k, there's a few things working against you. One is a lot of people will just invest the first time when they set it up, when they first enroll, and then they don't really change it after that. So you could fast forward 10, 15, 20, 25 years and you're like, oh, whoopsies. I've been in a cash fund that's been growing at a snail's pace for the last 25 years because back then I was a little bit scared of what was happening in the economy. But, I just been getting my statements and not really looking at how I'm invested. So that kind of scenario, either someone who's way too conservative, someone way too aggressive, and they don't change it at all, ever, the entire time that they're working at that employer. Very, very common. So the target date fund mitigates that, especially because what it does is it says, okay, it looks at, for example, the target date 2025 fund. They're usually in 5-year increments. So you have 2025, 2030, 35, et cetera. And so that date in that particular target fund should correspond closely enough with the date that you anticipate retiring. So let's just say the date that you turn 65. So if you're going to be 65 next year, then you should be in the 2025 target date fund. It's going to be appropriately invested for your age and your stage in life. And it is diversified. It has stocks, bonds, international stocks, large cap, small cap, mid cap. I mean, it is a total portfolio solution and it works so well in a 401k. So the other thing, when you invest on your own and you pick and choose, you're going to have your own biases, your own preferences. So investing in the target date fund is sort of like this autopilot that takes all of the guesswork. It takes all of the personal bias out of investing. It's also rebalanced every year. So it really is a great solution. Now, is this a great solution in retirement as well? So maybe you just want to leave your money in the 401k plan and you were in some, Vanguard, Fidelity, whatever, target date fund, and you like it, it's done well, and you just want to keep it there. In general, that could work. And I say that with some hesitation because although they are a great solution for millions of Americans across the country, there's nothing customized about it. Also, the way that it gets more conservative over time, that changes based on different target date funds. So you might have a higher or lower percentage in stocks versus where you really want to be in retirement. For a lot of people, those target date funds will have this sort of static, unchanging allocation once you get into your retirement years. Some of them, by their nature or by how the fund itself is managed, it may have more in large cap, more in certain areas. So I would say that in your retirement years, if you're going to be a DIY investor and you like the target date funds, then I think it's okay to have a portion and maybe even a significant portion I wouldn't put all of it in there because things change a little bit. Well, they change a lot in retirement. When you're working, you're just trying to maximize growth. You're trying to get to that target retirement date. When you're retired, though, you have these different moving parts with your income and your age, and you want to make sure that your portfolio is aligned to that. The other limitation of the index funds or the target date funds is that they use a lot of primarily sort of broad-based index funds, which is fine, but you could have some concentrations in some areas that you may not be comfortable with, especially in retirement. So I would say they're great for people who are in their working years and their saving years and their growth years. The target date funds, though, aren't really designed to be a total portfolio solution for someone who has transitioned into retirement. And I think it makes sense to look at some other options and do something that's a little bit more customized to your situation, or at least not have so much in target date funds in retirement. All right, that's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.